the next couple lessons, we're going to talk about what actually is a cryptocurrency and the foundation underneath that, which is the blockchain that's associated with it. Now, if you're familiar with cryptocurrency and blockchain, feel free to skip ahead past these two lessons. I just want to make sure that folks that need that real basis of understanding or that foundation or maybe a review have that, because I think that's very, very important when you're trading. It's important to know what you're trading and how it all kind of works. But if you skip ahead, that's perfectly fine. I won't know, so it's okay. All right, let's get started. So what is cryptocurrency? So it's really just a digital version of money, right? It's all electronic, it's digital, where the transactions are all done online, right? It's all virtual, there's nothing physical. You can't really hold a Bitcoin in your hand. You might see pictures and graphics of coins. They might look like little cold coins with a B on it for Bitcoin, but there actually is no such things as physical Bitcoin because it's a cryptocurrency, it's a digital asset. And the first ever digital currency, of course, was Bitcoin. That's why Bitcoin is such a brand name, why it's on so many exchanges and why it's so famous is people are familiar with Bitcoin. And a lot of people, when they think of cryptocurrency, they don't necessarily think about that as much. They think, Bitcoin. So that's the brand name behind it. So there are many different types of traditional or what you would call fiat currency, right? There's dollars or pounds or euros or rupees or yens or pesos, or you can just keep going, all these different types of currencies. In the same token, there are many different types of cryptocurrencies. Bitcoin and Ethereum are the two biggest, but you have Ripple, Cardano, a lot of other different types of cryptocurrencies that you can trade with, so that's very interesting that way. So similar to fiat currency in that way. But there's some differences too with regular, what we call fiat or regular money. So if we think about fiat money, like dollars or rupees and that kind of stuff, you need third parties or middlemen that we trust to facilitate and improve our transactions, right? Things like governments regulate and manage it, banks, accountants, they're all kind of involved, investment type things get involved too around that. And we call these trusted third parties they're all part of it, and we call them part of a centralized system. Now, one of the challenges with a centralized system in our history is, and why cryptocurrency came from nowhere, was there's always questions about how trustworthy are these different governments and systems. Some governments we know are not very trustworthy at all, right? And anytime you add a middleman on top of that, there's always some costs in there. There's always some cost of delay or transaction costs, or maybe just cost to manage money, for example. There's fees and things. So there's a middleman cost, and there was wondering, is there a better way? Is there a better way than this centralized system? And there was. It was the search for a more decentralized system, and that's where cryptocurrency kind of came from, is the idea of leveraging a decentralized system. And what was the decentralized system? Well, that's what we're going to learn about in the next lesson, which is called the blockchain. And we're going to learn about what is the blockchain. So to keep this part simple, think of a blockchain as a decentralized system. It's not centralized, it's decentralized system. And it's a network that is powered by its users, all these different peers or nodes. It doesn't have a third party or a central authority or middleman like a government or something like that controlling it. It's this decentralized system. And your system needed to be developed to support things like many other types of decentralized items, but particularly if you want to have a digital decentralized currency like cryptocurrency and things with that like Bitcoin, you need to have blockchain in the system. So if you didn't have blockchain, you wouldn't have cryptocurrency. They really do go together. And to put it in simpler terms, the blockchain allows it to be easier to send money to anyone on the network. Easier to send money around makes it easier than to trade money as well on exchanges. So if we think about it, a cryptocurrency, let's say like Bitcoin, consists of its own network. You have a Bitcoin network of peers. You have all these nodes all over the place, and every peer has a record of the complete history of all transactions as well as the balance of every account. Like if you were to actually buy something with Bitcoin, this would be all on the blockchain. If you bought, let's say, an airline ticket with Bitcoin, and I think you can still do that with Japanese airlines actually, it would be in the blockchain. It would be kept as a record there in that transaction. And this bookkeeping, this record keeping, is not controlled by one party or a central authority like a central bank of a government, or anything like that. The United States, India, Japan, wherever. It's a decentralized system. And it's all public, and it's available in one digital ledger, which is fully distributed across the network. So everybody sees what everybody's doing. In fact, the blockchain really acts as the public ledger. It's all transparent, it's all out there. The blockchain acts as the public ledger. So in the blockchain, all transactions are logged, including the time and the date, who are the participants in the transactions, and the amounts, of course, very important, of every single transaction happening all the time throughout the day and in the night. It runs 24 hours a day, 365 days a year. And each node in the network owns a full copy of the blockchain. In effect, a full ledger for everything that's going on, all being very automated. And that's the idea, is the nodes automatically and continuously agree about the current state of the ledger and every transaction in it. That's the idea, is that they're all in this agreement. So if anyone was to try to attempt to corrupt a transaction, the nodes would not arrive at a consensus and hence will refuse to incorporate that transaction in the blockchain. Remember, it's a universal agreement on these transactions. So every transaction is public and thousands of nodes are unanimously agreeing that the transaction has occurred on date X at time Y with these participants for these amounts. And everyone has access to a shared single public source of truth, right? So this is the idea of the blockchain and why it's so powerful and used in many ways, even beyond cryptocurrency with contracts and different types of things, but certainly is critical to the use of cryptocurrencies. So the big idea here, and what we're going to start learning and actually applying in the course, is that there are many different types of coins out there, but they're all using blockchain technology to operate. And they're all traded on a cryptocurrency exchange. Some are on more exchanges than others, which is an advantage for us as far as liquidity for traders, how easy it is to make transactions. But the idea is you have different coins all on blockchain, many of them on different types of exchanges, and these coins are traded as pairs. And they're paired with things like a fiat currency, for example. So you might have a cryptocurrency like Bitcoin being traded for US dollars. So we're trading that way. Or euros for another cryptocurrency like Ether or Ethereum. And you can have cryptocurrencies trade with each other like Ether or Ethereum with Bitcoin or with other ones too as well. So you have all these different trading options as far as that you can choose from as far as these different types of trading pairs. So wherever you live, maybe you like to trade in euros. Well, you can find euros, for example, that you can then trade for Bitcoin or any type of cryptocurrency that's out there. You just got to find the right exchange, have a whole section of exchanges about how to do that. So this course will give you all the ideas about how to make those selections and how to make good buy and sell decisions in this big world of cryptocurrency and the blockchain. So how is the actual value of a cryptocurrency determined? I mean, why is Bitcoin so much more expensive than, let's say, a brand new initial coin offering, for example? And how is that all decided? There's no central government deciding that or anything. It's all decentralized across the blockchain. And really who determines it is us, you, me, everybody who trades these cryptocurrencies. So, hey, aren't we powerful? That's pretty cool, right? So we determine the prices, right? So how that's kind of done is around, kind of those basic concepts of supply and demand and also what people perceive value as. So if, let's say you want to sell a cryptocurrency, you want to sell X for Y amount, and you want to, and somebody wants to buy it at that Y amount, then you have an agreement, right? If I want to sell it to you for this and you say, that's pretty good, Steve, I'll buy it from you for that, then we have an agreement and we have a trade, right? And we've established a market price. In effect, that's the idea of the current price is the market rate. And as we know, market rates or prices are constantly fluctuating. I mean, in seconds, the nanoseconds, they're constantly fluctuating as traders are matched up. And we'll talk about how we can use our indicators to see if that's a good potential trade for us or maybe not so good a trade for us. And that's the idea of technical analysis, is identifying when there might be trends or chart patterns or different opportunities that say, oh, I want to make this trade because, let's say I'm buying, I have a feeling it's going to go up, or maybe I'm selling and I'm like, I think this is starting to peak out, time to get out. So that's the whole idea of trading. But underneath all of that is that who's making those decisions is traders who are coming together and making those trades, buying and selling. Let's talk a little bit about what types of cryptocurrencies might be out there. And let me tell you, there are thousands of cryptocurrencies available, for trading that are out there. I saw a report or an article where I think it was saying there's over 4,000 of them. And That's a lot of cryptocurrency. And the idea behind that is it's actually relatively easy to create new coins. New coins come into existence almost pretty much every day. When a new coin is created, it's called initial coin offering. Have a lesson coming up on that. And the thing with it, most coins or cryptocurrency coins are actually very lightly traded or hardly get traded at all, these thousands and thousands. And it's really, crypto is dominated by a few coins that really are kind of the dominant players in terms of who's getting the most attention. So let's take a look at that. So here's a couple of graphics from different sources, talking about market capitalization and percentage of basically of the universe of a certain cryptocurrency coin. And market cap, by the way, is you take the current price of let's say a coin, and the number of times the number of coins available, right? So it's the same concept you'd use, let's say, like with the stock market. You take the stock's current price times the number of shares available in the stock market world. In the cryptocurrency world, it'd be the current price by coins available. And these are from different sources, so they might not exactly match up. It changes every day as far as these market caps, because prices go up and down, of course, every day as an example. But the thing you want to take a look at this, if you start looking at either of these numbers, you can see in terms of total numbers from this day I happen to select, how big Bitcoin and Ethereum are compared to the next ones after it. You can look at total market capitalization dominance as a percentage. This, from when this was pulled, Bitcoin is like 61% of the total cryptocurrency market. Very powerful, traded on many exchanges. Certainly a strong brand name behind that. Ethereum would be the next, but you can see how much bigger Bitcoin is even than Ethereum, 61% to 16. And then it goes way down from there. You get into Ripple, also known as XRP. So if you look on the right where it says XRP, that's Ripple. And there's other ones out there too. And those ones in the middle kind of fluctuate above and below each other all the time, with Polkadot, Cardano, Chainlink, Litecoin, a lot of different ones out there. So even those are actually some of the more commonly traded ones. Everything you're seeing on the right list are all very commonly traded. By the way, Tether is what's called a stable coin. It's a little bit different. Have a lesson on that too. So it's a little bit different. So if you look at that, say, especially you know a little bit about cryptocurrency, say, well, Tether's not technically a cryptocurrency. It is and it isn't. But we'll learn about stable coins coming up. The main takeaway from this is you want to see is like, okay, who's the big players? It's Bitcoin really dominant and Ethereum coming up second and rising very well, actually. And then you have a lot of other really good cryptocurrencies out there that are very frequently traded. And this gives us lots of options as far as traders of what we want to trade. We don't have to trade Bitcoin. You don't have to ever trade Bitcoin. You could just trade, Chainlink or Polkadot or whoever you like. So either way, you can trade what you like, but you can kind of see what's going to be the most liquid in terms of easier to buy and sell and trade would be these bigger type players, particularly like Bitcoin and Ethereum. So who's the big fish in the cryptocurrency sea? Well, it would be Bitcoin, right? I mean, Bitcoin is really the most established. It has this great brand awareness and certainly by far the largest market cap, as far as being, most traded and high price and lots of different types of, or lots of coins out there. And so many people have not heard of cryptocurrency or might have a hard time struggling, like, what is cryptocurrency? They'd say, but Bitcoin. Yeah, I know Bitcoin. So, and a lot of people, that's what they think. It's kind of like you think instead of like tissues, you might think of Kleenex as in terms of a brand name, for example. So Bitcoin is the big player out there. And it was really Bitcoin had that first mover advantage, right? They were the pioneer of that whole blockchain technology and really as a digital asset being traded as a virtual digital asset and made really digital money, possible. In fact, we might not have ever had cryptocurrencies if there wasn't the opportunity to add new coins. It would have been just Bitcoin. That's how big and dominant and more early mover it was. So that's the idea behind Bitcoin. And so if there's really a true, like you might call a core holding or a blue chip type cryptocurrency, it would be Bitcoin. I mean, Bitcoin is pretty much traded on most exchanges. You could even almost go as far as say all exchanges. I'd be, wonder why an exchange might not carry Bitcoin, for example, because some people want to use that not only to trade because it's very liquid, but also they want to use it in their trading pairs, right? Where they're going to trade Bitcoin for Ethereum or Bitcoin for Polkadot, whatever it might be. So that's how big and dominant Bitcoin is. Again, you don't ever have to trade Bitcoin. Just understand that it's out there and that it's very, 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 very traded and very, very followed very, very closely because it is the big player in the big sea of cryptocurrency. The clear strong number two and rapidly rising is Ethereum is number two to Bitcoin. And many are predicting that Ethereum will surpass Bitcoin in the future and become, the real dominant cryptocurrency in the future. It's still got a ways to go for that, but certainly in terms of like price, when you look at the price for Bitcoin versus, let's say, Ethereum, but the Ethereum definitely is on the rise. And why is that? Why Ethereum of all these thousands of coins? Well, Ethereum was also one of the earlier type of coins too, and a really early mover in terms of adding differentiation, making it different than Bitcoin, and adding some value too. So it kind of stood out that way in terms of what Ethereum does. So Ethereum is very similar to, but it's also very subtly different when you compare it to Bitcoin. That's the real key here. So Bitcoin is is on the blockchain, on their blockchain, focusing on tracking ownership of the digital currency is Bitcoin. That's the whole idea. Is you have a blockchain and you trade Bitcoin in its actual core Bitcoin part. Now Ethereum is all like that too, but its blockchain also is focused on running the programming code or a network, where other people can kind of become and add more applications and add things onto this network. So it allows the development of thousands of different applications on a single platform, the Ethereum blockchain platform or network in effect, and you can then build on top of that. So not only can you trade Ethereum, but you can also use Ethereum as far as the blockchain, and you can use Ethereum coins on their blockchain to conduct transactions for from somebody else, for example. And a big part of what Ethereum does too is this concept of smart contracts. Bitcoin doesn't do this. Ethereum would, and there's others who are now developing smart contracts, but Ethereum was really the real clear early leader and first into this. And a smart contract is basically a computer protocol that's intended to digitally facilitate, verify, or enforce the negotiation or performance of a contract, right? You have a contract, you have two parties, they agree to something. Well, how do you contract that? How do you enforce it? You can do it in a decentralized manner on the Ethereum blockchain. And by doing that, it eliminates the need and cost of middlemen around that, lawyers, all sorts of people got to go sign paperwork, that kind of stuff. And it's much, much more efficient and actually very secure as well. So let's look at a real example actually of a small contract. I don't know if they still do this, if they offer this, but this is how this is used. And this is from AXA Insurance. They're a French-based insurance company, and they offered like travel insurance amongst many other things, and they offered like on-time arrival insurance. So you can buy insurance for anything. You can buy insurance to guarantee that your flight's going to arrive on time, and if it doesn't, you're going to get paid. So let's say John, as our example here, is going to fly from New York City to Los Angeles, and he buys on-time travel insurance from AXA, right? So he would send $5, let's say in this example, you use whatever your currency is, but let's say $5 worth of cryptocurrency to the AXA Insurance smart contract, and he provides his flight number as part of that. And then automatically, AXA would send $95 to the smart contract. So right now you have a contract between AXA and John, and there's a total of $100 in the contract. All right, now let's see how the contract pays out. So if John's flight is on time, the cryptocurrency contract in effect is invoked, and AXA is sent $100 from the smart contract. And in fact, they made not $5, right? Because they put $95 in. Because John's flight was on time. They were guaranteeing his flight was on time. It arrived on time. And so they get their money back, plus they get John's premium of $5. Now, if the plane is late, then $100 is sent to John from the smart contract. His insurance is paying off. Just like if your house burned down, you would get your insurance to pay off, to help replace your house if such an unfortunate thing happened. So John, unfortunately, his plane was late. So $100 is sent to John from the smart contract. And everything is automatic. That's the thing. Everything is automatic. And that's why it's so great with a smart contract, because you think about all the time and money it saves. John doesn't have to worry about collecting or calling people or fighting for his money from AXA. It all just automatically happens. It just is automatically sent to him, and all parties are satisfied. So as you can see, Ethereum, and why it's become such a number two, is such a strong coin in itself, but also has a strong blockchain technology around it in the development of smart contracts and other things too, and allows these applications and other coins actually to build on top of the Ethereum network. That's where a lot of new coins or initial coins are actually running on the Ethereum network. So Ethereum is in effect the coin, and these ones that are running on top of the network are actually technically called tokens that are running on that. But for us, for buying and trading, we can consider them all coins, but there is a difference between native-based coins like an Ethereum or blockchain or Bitcoin, and then tokens that might run on a network like that run on the Ethereum network. So those are your clear number one Bitcoin, clear number two Ethereum. And the advantage for us traders is that it's easy to buy and sell these because they're on many, many different exchanges, many platforms, and they're very liquid, so we can make these buy and sell transactions happen very, very quickly. If we look at the biggest coins of the rest of them, not named Bitcoin or Ethereum, and you could maybe say Best or whatever, I don't know, but these are all sorts of different ones that we could trade. There's thousands of coins out there we can trade, but I'm going to highlight a couple extras of some of the bigger ones, as far as something that's real commonly traded on most exchanges to give you a feel for kind of what they're about, to give you an example of some of the different things or options that are out there. One of the ones that has been around quite a while is Ripple. You'll see it represented as XRP on the exchanges as far as its trading 3-digit ticker symbol or trading symbol. So Ripple is interesting because it's they're kind of in between this world of actually being a company, like it almost should be a stock, versus being a true cryptocurrency. It's got this dual function, and it operates as a digital currency. But it's also this digital payment network for financial transactions. So a lot of the big banks and folks actually will use Ripple for especially overseas transactions to quickly through a blockchain make this transfer of payments and money around the world very, very efficiently and quickly. So there's like XRP, Ripple, the kind of the company, and then XRP, Ripple, the digital currency that helps facilitate all that. So you might see Ripple in the news every once in a while about getting in trouble with governments and with regulators because they're trying to figure out, are you a company or are you a cryptocurrency? So, but they're one of the most commonly traded ones out there, so something to be aware of. Next one is Polkadot. And that was interesting where they created their own blockchain, or what they allow is actually they use other developers can create their own blockchain while using the security that Polkadot's chain already has. So you have the Polkadot blockchain, and then you have others who can build blockchains on top of that and leverage that security. So it's a little different than, let's say, a smart contract running on, let's say, the Ethereum network. It's kind of getting your own blockchain. But it was created by Gavin Wood, one of Ethereum's founders. So that's a big reason why it's popular. Anything kind of related to Ethereum, and as far as a history, gets a lot of notice in the cryptocurrency world. It's very similar with Cardano. ADA is this ticker when you look at that. And they were really, really based on research. Their whole thing was they brought together engineers, mathematicians, cryptography experts. Project was founded by Charles Hoskinson, one of the initial 5 founding members of Ethereum. So it was all project-based and really all about how can we make, from a research standpoint, a great blockchain network and coin token that goes with it, and that's Cardano. So a lot of people like Cardano too as well. So these are just a couple of the examples that are out there. A last one here, just to be more aware of, is Bitcoin Cash, BCH. And it's more historical, though it's very, very heavily traded still. But way back in 2017, it was really one of the earliest and most successful hard forks of the original Bitcoin. And so you might hear terminology like, oh, there's a fork of this cryptocurrency or the blockchain, or there's a hard fork or soft forks, these different things. So this is a hard fork. And really what they're referring to there is, due to the decentralized nature of digital currencies, if you don't have somebody who's in charge of everything just making a decision, there's no dictators over cryptocurrency. So if you're going to make a big change to the code that's underlying a coin, then you have to have a big general consensus around that. And the whole project and the whole setup has voting rights and how that happens. So there's an established process for that particular cryptocurrency. But sometimes, guess what? People don't agree, right? And when you have different factions just cannot come to an agreement at all, sometimes that digital currency will split, with the original chain remaining true to its original code, in this case being Bitcoin, and the new chain beginning life as a new version of the prior coin. complete with changes to its code. So it's a different type of code. And that's where Bitcoin Cash came from. And, one thing with Bitcoin, even though it's the most popular, largest traded coin, the blockchain is not necessarily the most efficient one out there. And that's where, Bitcoin Cash was saying, let's try to make the Bitcoin more efficient, or try some different ways as far as processing times and speeds and all that kind of stuff, as far as the actual blockchain itself. And so that's where that kind of came out of. So, understand if you hear things about forks and stuff, that's what's going on here. And Bitcoin Cash still very heavily traded, and was one of the, kind of the founding idea behind that. So those are just a few of the bigger coins out there, some of the more alternative coins other than Bitcoin and Ethereum. Again, there's thousands and thousands and thousands of coins, and new coins are coming all the time. What's called an ICO, or initial coin offering, and we have a lesson on that and how that comes to be. But it's pretty easy actually to have a coin, have a new coin be born. So, and those have their own special kind of thing we want to look at as far as initial coin offerings and whether you should invest in those or not, or when. So there you have it, some ideas of some initial coin, some different types of coins that are out there. In addition, a coin that you want to be aware of, or types of coins, are stable coins. And they are different. They're very different, and really not what we're looking to in terms of investing into a cryptocurrency where we're expecting the price, let's say, to appreciate in price. And so they perform a function in the cryptocurrency world, but they're not something you would necessarily be buying and trading on their own. They're more to facilitate buying and trading. So what are stable coins? So stable coins, basically what they do is they peg their market value to a fiat currency, or another external reference point. Let's say like the US dollar, right? So their market value is not based on trading, back and forth like other coins and other types of exchange traded things, like a stock in a stock market, for example, or a Forex market. It's traded, it's based specifically to that, pegging it to that fiat currency. And so you're not really trading it to try to, increase your value based on the stable coin. The whole idea of a stable coin is that it's stable, right? And the reason it came about is that cryptocurrency, as we know, is very volatile in general, as in the prices go up and down, pretty wide range, can be very, volatile as far as going up and down range of prices. And so what we needed was something that would add stability, something that was asset backed with real fiat currency behind that to facilitate things. And so stable coins made it easier make it easier to conduct business or trade without fiat currency. So you're using a stable coin in replacement of, let's say, the US dollar as a fiat currency. And also stable coins are designed to be easy to convert to fiat. That's where a lot of exchanges will have you, let's say, trade a stable coin for, let's say, Bitcoin, but then when you want to, let's say, cash out or take your money out, you'll convert it from Bitcoin to a stable coin, and then a stable coin is what allows it to be converted into your personal fiat currency you use, dollars, rupees, euros, whatever that might be. And so they'll use it that way to pair with a crypto coin on an exchange. So to give you some examples of ones, the most common and largest one, the first one, if not the first one, is Tether. Its ticker is USDT. And you might have noticed in the previous lesson where I was listing the largest type coins that are, in terms of volume, you had Bitcoin, you had Ethereum, and a lot of times number 3 is going to be Tether. And again, Tether's value is not going up and down as much because of it's being traded. It changes a little bit because of it's pegged to the US dollar. But it's not something you're trading in to trade to like you're trading, traditional true cryptocurrency. So Tether's the largest, and then Tether ran into some problems years ago as far as did they have enough, real hard assets in terms of dollars and things backing them up, and there was a little concern about some of their transparency stuff. You can go Google that and find out all about that. But what happened was arose a competitor to Tether, which was True, and you can see they kind of put the T at the front, TUSD, same thing pegged to the US dollar, as another type of coin, stable coin they find out there. And then there are other ones too, Gemini, which was developed by the Winklevoss twins, very famous in cryptocurrency, and the Gemini network exchange. And they've designed to be very regulated, and that's in a good way. They're trying to really build a lot of regulation in not only their exchange, but into their stable coin that's traded on their exchange to facilitate trade. So you've got Gemini, Eurs, which is basically the same thing as just using euros as that was pegged to Singapore dollar, pegged to Singapore currency. you can see, these different things that they do. But the main takeaway from this is that stable coins are different, and that, think of them as a way to facilitate your cryptocurrency trades and facilitate your trades on your exchange. Instead of using, let's say, your fiat currency to buy Bitcoin, you'd be converting that fiat currency into, let's say, Tether, and then you would use your Tether to buy and sell cryptocurrency and back and forth. Oh, by the way, they're pegged to, let's say, a fiat currency like Tether is the US dollar. That doesn't mean you need US dollars to buy Tether. You can use anything to buy Tether, a cryptocurrency that can buy Tether, or any other fiat currency. Just understand that the value of Tether is pegged to the US dollar as an example. And that is by far still the most common one. Well, the original cryptocurrency, of course, was Bitcoin, but then you have new coins coming all the time. And how does that happen? What's the process behind that, and what's involved, and what are the advantages potentially for us as traders? But certainly there's some risk around that too as well. So we're going to talk about that in this section around ICOs, or initial coin offerings. So basically, an ICO is how a new cryptocurrency is born, right? It's how do you create a new cryptocurrency? That can later be traded on an exchange. And basically what you need, as far as how it's done, is it's going to seem strange here, but you basically, a group of people get together, they form a project, and then they write a technical white paper about why they want this new cryptocurrency, what it's going to do, why their blockchain's great, or they're maybe, on another type blockchain like Ethereum or something, and why you should give them money, basically to raise money for their project, right? So that's the thing. Their whole deal with the technical white paper is they're raising funds for the project to try to get this cryptocurrency launched. And you can send it to them in fiat money, but usually with these, they want actual cryptocurrency, to be sent to them, Bitcoin or Ether, because they're all trying to, of course, exist in that cryptocurrency environment and want to support the decentralized network. Fiat currency is bad. We want new things, right? We want new cryptocurrencies. So they raise funds. And then they give investors tokens, which is kind of like the coin itself, or tokens, which will eventually, hopefully, be listed on an exchange, right? So the idea is that will become a coin, and then they'll be listed on an exchange eventually. So it's kind of like crowdfunding for cryptocurrency. It's crowdfunding for crypto. And some succeed, like Ethereum, of course, very famously. Some succeed and succeed wildly, and many others succeed. But according to a study from Boston College a few years ago, about 56% of these coins fail within their first 120 days. Either they never really even become a real coin, and that means your money, you may get it back, but you might not get money that you've sent to them back. That's a risk, of course, if you're doing the initial funding or helping those folks who are raising funds for the projects. Or maybe they become a coin, but they never get on many exchanges, and they're never really heavily traded, and they just kind of, disappear. With most people are trading Bitcoin and Ethereum, then some of the other top ones like Cardano and Ripple and all that. If you're the number 2,333 coin, you're not going to get much trading action around it, not much interest around it. Now, couple of things around with them too, with initial coin offerings, is there's very little regulations around it. In fact, some governments have banned initial coin offerings in their country, or those types of projects. So understand that, and that changes all the time, so just be aware. But there's a reason why they banned them, because it's, it's a little regulated, and it's a real fertile ground for scams. You can probably start thinking through this, like, what? You just write a paper and then you start raising money? Like, is that it? That's kind of what it is. And sometimes there's real true scams. Like the ICO never was real. They never intended to have a project. They never intended anything to do. It was just a scam to raise and basically steal money. And then you have these worthless tokens. So if you send them some Bitcoin, you send them some money. They did that for a while, and then they just kind of disappear, and you can't find them. They're disappeared. And then some are like, well, they'll do this kind of the scam for the pump and dump, right? Where you pump up a new coin that's come live, other people out there in the market. And usually they'll say something like, oh, it's the next Ethereum. This is so great. Look at this white paper. And so they'll try to pump the price up from the initial coin offering price, which is very low, get it up there, sell it, get out, and do that whole pump and dump. And then the whole coin has this bad rep, and it never really succeeds there. So it's a fertile ground for scams, and so just to be aware of that if you're looking at these newer coins. Doesn't mean you can't invest in them, doesn't mean there's a great upside in them, doesn't mean you can't make quite a bit of money on them. But I would say if you're going to invest a lot in, let's say, into initial coins, to have that be a certain percentage of your portfolio, but understand you're taking on a lot more risk, hoping for a lot more return, than if you were, let's say, trading, Bitcoin or Ethereum, which are risky in themselves compared to, let's say, stocks or certainly less risky investments like bonds or cash. So think about that when you're investing in ICOs, especially if you have that next great ICO. It's the next Ethereum. Oh my gosh, it's amazing. So just be aware of that. And to wrap up this section, you might also be thinking like, well, I've heard of stock IPOs, right? Initial public offerings. How does an ICO for cryptocurrency compare to a stock market IPO or a new company going public? So if we just real briefly look at, as we learn in cryptocurrency of the ICO or initial coin offering, they basically write a paper and there's no or to very little regulations around that. In comparison to the stock market, where you have initial public offering or IPO, you have to write a real comprehensive prospectus, and it has to be written in a certain manner, and there's a lot of government regulation around that. It's very, very highly regulated. You have to then get investment bankers involved and a lot of other approvals. There's a lot of expense, a tremendous amount of expense and time to bring a company from a private company to be publicly traded on an exchange like the New York Stock Exchange, for example, or NASDAQ. So there's a lot of work behind that and a lot of costs. So for cryptocurrency, very low cost, very little regulation. Stock, higher cost for that company, and then a lot more regulation to get it there. So that way, and many IPOs, are not super successful either, by the way. But it is certainly something that's much more regulated than a cryptocurrency would be. So just something to consider when you're looking to buy and trade cryptocurrency, and particularly if you love that initial coin offering or that ICO market. And there's new coins coming on almost every day now, sometimes weekly, but almost every day you can hear somebody's got a coin coming up. So a lot of competition for your eyeballs, so to speak, your notice of their initial coin offering. Let's take a short interlude and maybe some caution around the idea of traders behaving badly. Okay, and like, what? People kind of try to scam each other? What? On the internet? Okay, yeah, it happens. And so we want to talk about one of the more common things you'll see out there, just so you're kind of ready for it and be prepared for it. And other things that are out there too. So one thing is government regulation. I'm not going to talk about politics where you like big government or small government, but government regulation is designed to protect us, at its core idea, especially in like the securities area. And the idea is that cryptocurrency is less regulated than other types of securities by far, but it's becoming more regulated all the time. And that helps us. That helps to protect us. Certainly having a certain amount of regulation helps protect us as regular everyday people, as traders. One challenge with cryptocurrency is it's more lightly traded than other markets. Lightly traded means not as many transactions and that kind of stuff. So it's easier for somebody to maybe do a little gamification or manipulation with like cryptocurrency than like larger big markets like the stock market, for example. Stock market can be vulnerable in things like low cost or penny stocks, but it's harder to manipulate somebody big like Apple or Tesla or whomever, Amazon, right? Because there's just so much trading volume happening on there. And the one thing that happens is that traders will post false things. What? Yes, they do. They'll post false things to try to raise the cryptocurrency price artificially, right? And then they're going to try to sell for a quick profit. So they're going to kind of do that. And we actually have a term for that, and I'm going to show you an example of that, and that's called pump and dump. And the idea of a pump and dump is it's kind of like a three-step process. First thing a trader behaving badly would do is they would buy early into something, right? They would buy early. In this example, it'd be at, let's say, 0.10. And then they're going to really try to pump that, artificially pump up the price on that. They're going to, send out blog posts or send out social media things saying, this is a hot tip, or the next big thing, is this cryptocurrency. And there's definitely a breakout coming. They're talking about technical analysis stuff. Look at the breakout. Look at this chart pattern. It's going to break out. Or they'll promote it on a forum or a blog or YouTube or Reddit or whatever it is to try to pump up that price, let's say up to the 0.90. And then the third step is they quietly, behind the scenes, while they're pumping, is they'll sell. They'll then sell at that 0.90. they'll get out and they've made their profit while other people experience the loss as it kind of falls apart. And this is easier to do with lightly traded securities like cryptocurrencies. And even in the cryptocurrency world, things like Bitcoin or Ethereum, the big guys, a little harder to do with, but certainly with some lesser known alternative coins or altcoins or newer coins or initial coin offerings, or coins that have just come off an initial coin offering and might be lightly traded on a few exchanges, easier to manipulate that way with a pump and dump scheme. Things, as I mentioned before, like in the penny stocks in the stock market world. So this isn't just a cryptocurrency. It just seems to be a little more prevalent in cryptocurrency. And I think it's because, there's a lot more light trading on that. So it can be more impactful for the pump and dumper. One thing to kind of watch for is, watch for any really unexplained, very rapid rise in price and be looking for these things if you're starting to see this kind of pumping going on. And also consider the source too. Who's doing it? Is it some kid in his basement or whatever? So consider the source as well. This is a real cryptocurrency chart. It is a real cryptocurrency chart. Actually, it's a time and period from Ripple, otherwise known as XRP. And there's a period here where I wonder if this was a pump and dump thing. If you look at this chart, do you see where there might be the pumping and where there might be the dumping, and how it led up to that? Let me throw a whole bunch of stuff on this chart and let's walk through it. So you can kind of see what actually happens out there without a nice little animated graphic. So as you can see, these are the, let's say, hours. It could be days. Let's say this is actually days. And each of those candlesticks represents a day. Some are up in the green and some are down in the red. But you can see not much happening, where they're all kind of staying about the same. That blue line going across is a moving average line, by the way, where crosses above that would be a buy signal. So nothing much happening. So a pumper would buy one and not much is happening there, right? And then they would say, this is the greatest thing ever. This is going to be bigger than Ethereum. Oh my gosh, this is just so amazing. And then it starts to go up. And then let's say something happens, like it approaches or maybe starts to go past that moving average line. So they pump even harder. Oh, it's going past the moving average line. It's ready for a breakout. And then the next day you see the big long green arrow, a big green candle. It does break out, maybe artificially, and they're pumping real hard now, right? Like, oh my gosh, look at the prices are skyrocketing. If you don't get in now, it's a mistake. And then it goes up, that day after a little bit more, right? A little bit of pullback, but it ends up finishing higher the day after that. And then if you see that red candle, you have that big, long, tall up wick, the wick up to the higher pair. That's showing the range of prices to the top end. And you can see that people were buying and selling really high up there in terms of the price range compared to where they started at. And they got real high up there. And that's where a lot of unfortunate people bought in at that real high part. And the pumpers are now dumping, right? They got it spiking up there. They've had a couple really good days in a row and then had a spike and they're like getting out, right? And meanwhile, people who are going to be victimized, they got up higher. And as you can see in the red candlestick, the bottom of the being body of the candlestick in a red candlestick is where it closed lower. So if you look at that big rectangle at the very bottom line, not the wick part of the bottom, but the bottom of that rectangle, that's the closing price. And you can see, wow, that came way down from what they might have bought it from just in that same day. So that's the idea of the scam, is you pump it up and you dump it there. And then you can see it starts going back towards that moving average line and, whatever happens afterwards happens. But the idea is a lot of people bought in very high and it was all because of a scheme going on behind the scenes. So with that, just be aware of it. It's not super common, but if you see something like some kind of thing unusual going on, it probably is. And don't have that fear of missing out. Just really approach it from a technical analysis, from a tactical, unemotional standpoint, and you'll be fine. And it's better to be wrong and maybe miss out on something than be a victim of pumping and dumping, because that's where you can really lose quite a bit of money quickly. So just things to be aware of and evaluate. And now let's keep going and understand how we can be not traders behaving badly, but traders being successful or successfully.